All right, I'm going to get started with this year's 2025 State of the Nebraska Self-Storage Market Report. All of the numbers, metrics, et cetera, that you're going to hear today are going to be dated through the beginning of October. I'm good, but I'm not that good, unfortunately. But yeah, so this is going to be year-to-date figures, and I'm hoping to just give you all a lot of good insight into kind of how the market has changed over the last few years, what it's trending towards, and how that affects you as an owner. I want to say I appreciate all of you coming today. It means a lot, and obviously congrats to Jeff here on being named the new president of the organization. Very excited to see kind of what it looks like moving forward. So jumping into it here, a little bit about me. I was born and raised in Kansas City, Missouri. Moved to Arizona when I was 18 and jumped into brokerage at the ripe age of 19. And since day one, I have worked tirelessly to service self-storage owners in the state of Nebraska and some other surrounding states in the area. Sold about $41 million worth of self-storage facilities, primarily in the state of Nebraska. And currently pride myself on being the number one self-storage broker in the state, which is a very unique title. Jump into it. So just kind of a quick, brief summary on, the last 2 years and what that's looked like for the market. So in 2023, we saw quite a large correction in the market. That was based largely on the increased borrowing cost that we saw happen at the tail end of 22. And so we saw a lot of investors pull back. And then in 24, there was a lot of stabilization. And now, thankfully, we're seeing quite a bit of renewed momentum. So total sales volume is up 66% from the end of last year, which is a pretty notable and material rebound. And I know there's quite a few deals in escrow that are looking like they're going to close prior to the end of the year as well. A lot of this, influx of capital into the market that we're seeing is stemming largely from private capital rather than, your standard REITs, like Extra Space, Public Storage, CubeSmart, et cetera. So a lot of it is going to be, first-time storage investors. It's going to be, existing regional and local operators. And we're seeing, just in terms of product types across the board, self-storage is remaining, it's holding that top position in terms of pricing resilience and just general velocity. And we're seeing that on-market representation is actually outperforming off-market sales for the first time in, really, I think, a long time, if not ever, just across the state. So for some quick context, macroeconomic perspective here, we typically base our understanding of debt off of the 5-year and the 10-year treasury. 10-year tends to be the best basis for that. It's been extremely volatile the last few years. We've seen, obviously, the Fed has cut rates. We've seen the 10-year counter that entirely, which is unique and almost unheard of. But that is really a large, cause, or I should say, it has a large effect on your cost of borrowing, so to speak, because that's how lenders are basing their rates. And thankfully, we're seeing it start to trend downwards. And I think it's going to keep going in that direction, particularly as we get into next year. I think Q1, we're going to see a lot of momentum and a lot of velocity. But ultimately, all of this has just caused credit tightening, so to speak, where institutional deals aren't getting done as much as we're seeing, smaller deals that are maybe in that sub $1 million, sub $2 million range. And a lot of it is contingent on, square footage available too. A lot of the deals I'm seeing are less than 40,000 square feet. Most of them are trading outside of Omaha and Lincoln. So, it's a lot of the smaller, more tertiary markets that we're seeing deals get done right now. And the biggest constraint for buyers is really just borrowing cost, and that's what I'm hearing. So we're going to anticipate that with the trend of the current 10-year, we're going to come into a better borrowing environment as we go into next year. So as far as transaction velocity goes, this is a good chart that shows you kind of the big delta that we've observed over the last 3 years. And you can see that 2025 is absolutely blowing 23 and 24 out of the water. It's even beating 22, which is very notable considering, for the first 3 quarters of 2022, interest rates were still pretty low compared to where they are now. The other thing I'd like to point out too is you'll see on the graph there that the blue is going to be your on market and the white is going to be your off market. So the makeup of the percentage of volume by on market sales is actually increasing significantly with time. And so really what this indicates is that seeing on market volume increase 160% from where it was last year is indicative of the notion that sellers are more actively seeking representation from a broker like myself who represents them on the sale of their property and then sources as many buyers as possible to make sure that they get a competitive bidding atmosphere. This is another chart that shows a different metric in which we can gauge the velocity and the year-over-year growth of the market based on the net rentable square footage. So you can see again, on market is accounting for the majority of that versus off market, and is also up from last year, and it's close to beating 2022. And I'm cautiously optimistic about the fact that we will actually beat 22 for square footage that's trading as well. But what this really means is that the average facility size is offsetting the lower deal count. And that's what's really causing that big difference from that last chart showing the increase in volume by a price metric. Then we can see by sale count here. This isn't as, I would say, notable, but it is something to point out as well, just in terms of deal count. We're seeing it's pretty steady across the board, but it's back again. It's back to it's indicative of the fact that the market is maturing to an extent. We're seeing a lot more consolidation from these private, local, regional operators that have existing locations as well. So that's playing a role. But again, you're seeing on-market sales are eating up a big portion of that. The interesting thing about this chart, in my opinion, is the fact that you're seeing a higher amount of sale counts for off-market facilities than you are for on-market. But on the other 2 charts, you see a much larger spread for the on-market. And the reason why is because off-market sales account for significantly lower sale prices on a per square foot basis than you do see with on-market sales. So, like I was just saying, here's a good example of that. This shows the average sale price on a dollar per net rentable square foot basis compared to on-market and off-market sales over the last 3-4 years. And you can see that there's an 81% premium just this year to date from on-market to off-market sales, which again just kind of reinforces that point that when you're looking to do a disposition for your storage facility, there's a ton of value in having a broker involved in the transaction because ultimately that's what's going to drive up the competition. Year-over-year price growth, 33% on-market, off-market flat. And then jump into some market achievements here. So this is a little bit about some of the work I've been doing in the state. So this shows the average sale price for the last 2 years from your on-market, off-market, your off-market, all existing brokers who have sold transactions, and then myself. So I currently hold 88.9% of the gross sales that have occurred in the state and 85% market share for sale volume. I've sold 373,000 net rentable square feet this year alone, and I've held a dominant market share in the state since 2023. And this just reinforces the fact that when you typically work with real estate professionals, there's a number of different types. There are those who sell residential properties. There are those who sell residential and commercial. I sell exclusively self-storage facilities with a very specific focus in the state of Nebraska. And knowing that allows me to be very informed about what's going on in the market and stay in tune with owners and understand what they care about and understand other developments that are happening that are affecting the values of properties in the area. So there's a ton of value in that, and I think there's just a lot of value in general, regardless of if you're looking to sell or not. Staying in contact with somebody like myself who can give you good information, give you good advice, and really pool together the information that I receive from owners and then relay it back to you. So I want to jump into a few case studies. We sold this deal in March of this year. This is the largest known transaction for self-storage in the state of Nebraska that was facilitated by a broker. We sold it for $15.5 million, 208,000 square feet, which shakes out to around 72, 73 a foot, which is pretty unheard of on a price per foot basis in a town like North Platte, where the population is roughly 20 to 30,000. This was quite a long effort on everyone's behalf, the seller, myself. But we ended up sourcing a buyer. It was a private equity group that owns quite a few locations in Missouri and other portions of the country, mainly the Midwest. We were able to get the deal done by using a blended financing structure that included both seller financing and conventional financing. And using that structure is ultimately what got the deal done. We were able to put the buyer in a position where they only had to put down essentially 1% on the entire deal, because they rolled in the seller financing portion as their down payment for the conventional loan. So it was a really unique deal to get done, and we couldn't have done it without the support of local lenders, and just that kind of creative financing is really the route that we've been pursuing with a lot of owners in order to make record sales occur like this one. But it was a unique opportunity with over 208,000 net rentable square feet available, spread between 4 facilities. It was a strong transaction. Fun fact: the buyer on it is actually from Lincoln, one of the principals of the private equity company, and he recently acquired Michael Jordan's estate in Highland Park. You guys might have heard about that in the paper. So, fun fact. We also sold this deal at the tail end of last year. I believe we closed in mid-December. This was a 4 or 5 year effort on behalf of the seller. He'd worked with pretty much every other brokerage firm in the country and tried to list it, I think, dating back to 2019, 2020. And we ultimately sourced the highest offer that he had ever received and closed on it with a group out of Utah. But it was quite the struggle, just from start to finish, working through a lot of different issues going on. It was an older facility, so there was a lot of questions about due diligence and site visits and third-party reports that we had to work through with the buyer, and obviously make the seller comfortable with. So all in all, it was a good transaction to complete, and I know the seller was pretty pleased about the outcome, considering, again, he had been trying to complete the disposition for a number of years. This was a unique one. We sold this, I believe, in 2023, and this is in Hastings. And we came across a unique problem that I had not quite come across before, where essentially we realized after doing the Alta survey that a couple of the buildings actually extended into the property owned by the railroad. So if you can imagine, despite the fact that the property was developed 20 plus years ago, that can be a little bit of an issue from a lending perspective and a title perspective. And so we had to essentially start to figure out what our options were moving forward, because at a certain point you can pursue an adverse possession claim, but I can imagine nobody in here wants to go and take the railroad to the courts. So we didn't pursue that one because, at the end of the day, even if you pay all the legal fees, it's going to take over a year, and then you don't even know if you're going to get the judgment that you're seeking. So what we did instead was I had ultimately sourced a buyer who himself was a GC, and we discussed the ability to essentially remove portions of the building in the middle of escrow, and then rather than retrade the sale price, the seller preferred to pay him out directly, and we paid him a bit of a premium to do that, considering the fact that a certain amount of the income would be removed from the property, having removed some of the units. So it was just a really unique and difficult transaction that lasted 7-8 months. But seller was thrilled with the outcome. Buyer was happy with the facility, and ultimately it took a lot of just kind of negotiating with selling the opportunity of the deal itself, given that Hastings is a really strong market, demographics, supply-wise, rent growth-wise, and there was some expansion room on the property as well. They were also repeat buyer and seller of mine, so it just kind of goes to show the value of relationships in this business. So on versus off market performance, like I kind of hinted at earlier, we typically see a 70 to 80% market premium on a per net rentable square foot basis for self-storage. And ultimately, the reason why we see such a big premium is because you're increasing the exposure, with the sale of these properties when you're bringing them out fully on market. If you're interested in selling your facility, the question becomes, would you rather put it in front of, maybe Joe, your neighbor, and whoever else, 3 buyers, or put it in front of, 3,000, 30,000 buyers and put as many eyes on it as possible to create that bidding atmosphere? The other thing too is it's just in terms of how people are evaluating storage deals, it's getting a lot more granular. I mean, day by day, there's so many different valuation metrics that people are looking at from a lending perspective, from very, very expensive and unique storage software, whether it's metrics like square foot per capita, population growth. I mean, there's so many different demographics that people are looking off of as well. And so I think what really makes a deal get done in today's market is having somebody who's able to speak to the deal thoroughly and sell that dream to a buyer and make sure that it ultimately is consummated. As far as investor profile goes for the state, again, the majority of the buyers we're seeing are going to be private investors. So it's going to be people who are likely in the state or in the region that have existing portfolios and are looking to expand their footprint, or maybe a first-time storage investor. That tends to be the most common investor profile that I work with. But we also do a lot of work with middle market private equity groups, family offices as well. But as far as REITs go, we've seen that almost entirely muted. I would say this year and kind of really just the last 3-6 months, I've really started hearing for the first time in the last 3.5 years, these REITs picking their pencils back up and actually underwriting deals and taking an interest in some of these markets. But for the time being, and at least for the last 3 years, it's majority been private investors. The only other thing we're seeing that's playing a big role is a lot of owners looking to 1031 out of single-family rentals, looking to 1031 out of multifamily. So we're seeing a lot of that as well. There's been quite an exodus from rentals into self-storage. So as far as the lending environment goes, at this point, most of the rates I'm hearing are about 6 to 7% on current. I've been hearing 6.5 a lot recently. They've come down pretty significantly from the last 9 months or so when I was hearing 7.5 plus. As far as LTV, we're looking at, people need to put down typically 25 to 35% on a deal. It really just depends on what your financing structure looks like with your lender, whether it's a DSCR loan, SBA loan, conventional financing. There's a wide array of them, but typically, your relationship with your lender is going to supersede any kind of competitive financing that I or my capital markets could source on your behalf. Other than that, I'm hearing a lot of 5-year terms, 25-year amortization. Not very much in terms of 10-year terms with 30-year AMs. So that's kind of what I'm hearing more than anything. But local and regional are dominating origination right now for self-storage, particularly in Nebraska. I don't hear a lot of guys telling me they're using, Fannie Mae and Freddie Mac. I'm hearing a lot of, Western Nebraska Bank, 5 Points Bank, Nebraska Land Bank. And so those are going to be your typical lenders that I'm hearing about. That along with credit unions and life cos as well. Okay, so my outlook for 2026 is I think we're going to see a pretty modest cap rate compression. So I don't think it's going to be anything too crazy. I think it's going to be an improved market, even more so than this year, which this year already is looking up. I mean, it's already beating last year. But I think we could reasonably expect to see cap rates drop about 25 to 50 bips. And as far as cap rates go, I mean, they're very subjective. It's all dependent on what an operator is able to run the facility for. Some people are accounting for management fees, some people are accounting for payroll, some are not. It depends on the operator. Typically, local existing operators are going to run at a 20 to 25% operating expense ratio, whereas a national or regional operator is going to run at a 30 to 35% operating expense ratio. It just depends on a number of factors. Obviously, the stage of lease up that the property is in, and the operator themselves and how efficiently they can run it. But I think transaction volume is going to trend a lot more positive. I think we're going to see people fleeing from securities and coming more into real assets as the markets, some would say, has reached its peak in terms of stock market. And I also think that with how much limited new construction there's been over the last 2-3 years because build costs have gone up so much, I think it's going to make a good opportunity for owners and a great case for owners to increase their rental rates long term. But yeah, that's kind of my general outlook for the market. Thought I'd put this graph up too. This just kind of shows the top 3 storage brokers in the state of Nebraska, which again reiterates the point that on current over the last 2 years, I've controlled approximately 85% of the volume. So if you guys are looking to pick up more storage, make sure to find me. I'd love to figure out what your buy box is and make sure I get the right deals in front of you. And then I had a Q&A, but it sounds like we're doing a panel. So I think I'll just hold off on that for now. But do make sure to find me prior to the end of the conference. Like I said, I specialize in self-storage. I'm not just here to try and convince you to sell your property. I don't gain anything from bringing out overpriced deals and working with unmotivated sellers. It's not a very good use of my time. The thing I care about more than anything is building relationships with you guys as owners, bringing you value, bringing you deals. I would imagine the majority, if not everyone in this room, has zero interest in selling and a lot of interest in buying more facilities. So please do find me. I'd love to make sure that I get it on my radar, or get you on my radar in terms of what you're looking for. And the other thing too is if you're ever interested at all or just generally curious what your facility is worth, I'm always happy to put together a free evaluation. And the value in that, I think, for you as an owner is I'm going to do a deep dive into the surrounding market and really ideally tell you how I would personally add value to the property in the form of rent growth, in the form of, if you've got grandfather tenants, whatever it may be. I'm going to find what that pain point is for you, and then I ultimately want to convey that to you, and hopefully you're able to gain something from it. So.
Mason, what other states do you represent?
So I'm licensed in 4 states. I'm required to be licensed in my home state of Arizona, but I also have a license in South Dakota and Wyoming. I've done deals in Wyoming, Montana, Nebraska, and Iowa. But Nebraska I've done about 41 million in volume, and I think 36 million of that has been in Nebraska. So the majority of the deals I've done have been in the state. I've done deals in towns as small as Marquette, all the way up to Omaha and Lincoln. So I'm very, very familiar with the nuances and just every aspect of Nebraska and the inner workings of it. And it's really the state that I personally enjoy doing work with the most. So, yeah. Cool. Well, I look forward to the panel. Hope you guys have some good questions for me, and thank you for your time.